It's 12:47 in the morning in Strasbourg, France, and a fire alarm just went off inside a five-story building most people have never heard of. Within hours, that building is gone. Not damaged, gone. And along with it, the websites, the customer records, and the digital lives of companies scattered across an entire continent simply vanish from the internet, some of them permanently. This actually happened in March of 2021, and it exposed something most people never think about. The businesses that got wiped out that night weren't destroyed by hackers or bankruptcy or bad decisions. They were destroyed because the room their entire company lived inside of caught fire, and they had no idea that room even existed. That building was a data center. And here's the uncomfortable truth hiding underneath that story. A data center doesn't sell computers. It doesn't sell storage. It sells the guarantee that a disaster like that will never happen to you. That guarantee is the entire product. Everything else, the servers, the cooling, the security gates, exists only to protect one invisible promise. And once that promise breaks, even for a single night, it can end companies that had nothing to do with the fire itself. So why would anyone build a business this fragile? Why would investors pour tens of millions of dollars into a warehouse whose entire value depends on nothing ever going wrong? Stay with this, because the answer explains one of the strangest and most profitable industries in the modern economy. And right now, that industry is being reshaped by something almost nobody predicted 5 years ago. Artificial intelligence. Training and running AI systems requires so much continuous computing power that the entire economics of this business are being rewritten in real time. And we'll come back to exactly how, because it changes almost everything you're about to hear. Let's start with the part almost nobody gets right. Building one of these facilities isn't like building an office. The land alone can dictate the entire business. Because a data center doesn't chase population, it chases electricity. A single large facility can draw as much power as a small city. So before a single brick is laid, the first real decision is whether the local power grid can even support it. Land near abundant, stable, low-cost energy is rare, and that scarcity alone can push site acquisition into the tens of millions of dollars. Construction comes next, and it isn't optional spending, it's structural necessity. Redundant power feeds, backup generators, reinforced flooring rated to hold thousands of pounds of equipment, fire suppression systems, and biometric security all have to exist before a client ever signs a contract. Industry estimates put construction for a mid-sized facility somewhere between $8 and $12 million, and that number doesn't include a single server. Then there's a layer most viewers never even think about, because it happens entirely on paper before construction even begins. Permits, environmental reviews, zoning approval, utility negotiations that, in some regions today, can take years rather than months, financing structured around debt covenants that assume the facility will be profitable years before it opens. Working capital set aside just to survive the gap between finishing construction and signing the first paying client. None of this shows up in a photo of a data center, but it can quietly consume as much time and money as the building itself. Now add the equipment, and the number multiplies again. Servers, network switches, cooling infrastructure, fire suppression, access control. A fully equipped mid-sized facility can require another $20 to $40 million in hardware, and here's the twist that surprises almost everyone. Much of that hardware becomes technologically outdated within about 5 years. This isn't a business where you build once and coast. It's a business where the most expensive assets are quietly losing value the moment they're switched on. But that's only part of the story, because once the doors open, a different kind of pressure begins, and it never lets up. Electricity alone can consume 20 to 40% of total operating expenses, and that's not just about running servers, it's about cooling them. Every watt of computing power becomes heat, and that heat has to go somewhere, which means facilities often spend nearly as much energy fighting heat as they do generating it. Here's a fact almost nobody outside the industry knows. Those enormous backup generators sitting outside every data center, the ones designed to kick in the instant grid power fails, can cost millions of dollars to install and maintain. And on a good year, they might run for a total of only a few hours. Owners are paying an enormous, ongoing price for a machine they hope to never actually need, and that single detail tells you everything about how this business really works. It isn't selling performance, it's selling insurance against the one moment nobody can predict. And that insurance gets tested more often than people assume. Take a hospital network relying on a remote data center to store patient records. When a regional cloud outage briefly knocked systems offline in one well-documented 2024 incident, some healthcare providers couldn't immediately pull up patient charts or process certain systems, and doctors had to fall back on paper in the middle of active care. Multiply that same disruption across banking networks that can't verify a card payment or an airline that can't confirm a booking, and downtime stops being an abstract inconvenience. It becomes a grocery line that won't move, a flight that won't board, a prescription that can't be filled. This is why the promise this industry sells is worth so much money. Because when it breaks, ordinary people feel it immediately, long before any executive does. Here's a misconception that costs new owners a fortune. People assume these buildings are nearly unmanned, run by machines. In reality, they require around-the-clock technical staff, security personnel, and specialized engineers who understand electrical redundancy and network failover, and those specialists are hard to find and harder to keep. On top of that sits a long list of expenses that never make it into anyone's imagination of this business. Property insurance written for catastrophic risk, corporate taxes, licensing fees for the software running every rack, cybersecurity teams working to stop intrusions that never make headlines because they were stopped in time, network transit costs for moving data in and out of the building, and a constant, rolling budget for replacing hardware before it fails. But here's what really determines whether a facility makes money or quietly bleeds it. One failed cooling unit, replaced too late, can overheat an entire row of servers in minutes, and the resulting outage doesn't just cost the repair bill. It can trigger contractual penalties written into client agreements, sometimes worth more than the equipment itself, because the contract wasn't really about the hardware, it was about the guarantee. Add it all together, and operating costs can quietly consume 60 to 70% of revenue before an owner ever sees a dollar of profit. So if the expenses are this brutal and this constant, how does anyone actually make money in this business at all? Now imagine this. The fortress is built, the staff is hired, the bills are paid, and still, none of it guarantees profit, because of one number almost nobody outside this industry has ever heard of: capacity utilization. Here's the hidden economics that changes everything. A data center's profitability isn't set by how much space it has. It's set by how much of that space is actually rented and actively used. Facilities are often deliberately overbuilt, with extra room designed for future clients who may not arrive for years, which means a huge share of the building can sit there, still costing electricity, security, and maintenance, while generating exactly zero revenue. And it gets stranger. Many large clients pay to reserve capacity they aren't even using yet, locking in space today to guarantee it exists tomorrow, especially now that AI companies are racing to secure computing power before their competitors do. This reserved capacity is essentially the client buying certainty for themselves, the exact same product the data center itself is selling one level up, which means the entire industry is really just certainty being resold again and again, layer after layer. That sounds risky, until you look at how the money actually gets locked in. Most revenue in this industry doesn't come from short-term renters. It comes from contracts running 10 to 15 years, signed by corporations who need guaranteed capacity for the long haul. Once a client signs, they almost never leave, because migrating enormous volumes of data to a competitor is slow, risky, and expensive. Economists call this a high switching cost, and it's the quiet mechanism that turns a brutally expensive business into a remarkably stable one, because a facility that reaches high utilization suddenly gains something called operating leverage, where each additional client costs very little to serve, but adds almost pure profit on top. Scale it up further, and the largest operators gain something even more powerful, the kind of economies of scale that let them negotiate cheaper electricity, cheaper hardware, and cheaper financing than any smaller competitor ever could, which is exactly why this industry keeps consolidating into fewer and fewer giants. So why would a massive corporation rent this capacity instead of just building their own? This is where the story stops being about concrete and starts being about the human mind. Executives aren't purely comparing costs on a spreadsheet. They're terrified of blame. If an in-house system goes down and customers can't check out, can't log in, can't access their accounts, that failure has a name attached to it inside the company. Renting capacity from an established operator spreads that risk and, just as importantly, spreads the blame. There's also raw loss aversion at work, because the fear of catastrophic downtime outweighs the appeal of saving money by owning the infrastructure outright. 1 hour of a major streaming platform going dark can cost more than years of rental fees combined. So businesses choose the safer, more expensive option almost every time. Reputation, trust, and the simple desire to never be the executive who has to explain a failure in a boardroom, that's what actually drives this decision, far more than price ever does. There's another layer most people never think about. Competition in this industry isn't really about who has the fastest hardware, it's about who can make risk disappear most convincingly. And risk doesn't just come from fires. In 2021, an AWS region on the American East Coast went dark for more than 5 hours, and the disruption rippled outward into airline bookings, payment systems, and streaming platforms that had nothing to do with Amazon directly. They simply happened to be renting space inside the same digital building. Years later, another outage in that same region knocked out everything from messaging apps to major retail platforms in a single morning. These moments reveal the uncomfortable truth of the industry. When you rent certainty from someone else, you also inherit their mistakes. Now here's where artificial intelligence changes the entire equation. Training and operating AI systems doesn't just need more servers, it needs specialized chips that draw far more power per rack than anything the industry built for a decade. And demand for that power is growing so fast that some utilities are now telling developers they'll have to wait years, not months, just to get connected to the grid. In some of the most in-demand regions, interconnection delays already stretch past 3 years, and the companies willing to lock in electricity contracts years in advance, sometimes called power purchase agreements, are the ones actually able to build. Land isn't the scarce resource anymore. Power is. And that single shift is quietly transforming data centers from real estate businesses into something closer to energy companies that happen to also run servers. Regulation adds yet another pressure point, because data privacy laws differ wildly from country to country, and a single compliance failure can end a contract worth hundreds of millions of dollars. Add in rising energy prices, unpredictable interest rates on construction financing, and pressure from regulators and investors to meet sustainability targets, even as electricity demand explodes. And older facilities can suddenly find themselves outcompeted, not because they did anything wrong, but because the industry moved faster than they did. So let's put real numbers to all of this, using realistic industry ranges instead of invented ones. A mid-sized facility might require a total investment somewhere around $40 to $50 million once land, construction, and equipment are combined. A fully leased facility of that size might realistically bring in $15 to $25 million a year in revenue. Here's the simplest way to picture what happens next. Out of every $100 that comes in, somewhere between $60 and $70 disappears immediately into electricity, staffing, and maintenance. Of what's left, taxes, financing, and depreciation take another meaningful bite, often leaving a net margin somewhere in the range of 10 to 15% in the early years. Break even for a brand new facility can take 3 to 5 years, assuming the owner steadily signs long-term clients. For those who reach full capacity and hold on to those contracts, annual returns somewhere between 8 and 15% aren't unusual, which is respectable, but nowhere near the guaranteed goldmine most outsiders assume this business to be. So is owning a data center actually worth it? It depends almost entirely on patience and timing. The owners who succeed are the ones who lock in cheap, reliable power early, sometimes years before they even break ground, secure long-term corporate clients before construction even finishes, and treat efficiency less like an expense and more like a religion. The owners who fail are usually the ones who underestimate operating costs, overestimate how quickly they'll fill their capacity, or get caught expanding right as interest rates or energy prices rise against them. And looking ahead, the industry's biggest challenge isn't demand. Demand from AI alone is expected to keep climbing for years. It's whether the power grid, the workforce, and the planet can keep up with an appetite for electricity that's growing faster than almost anyone forecasted. So the next time you picture a data center, don't picture blinking lights and humming machines in some anonymous warehouse. Picture that fire in Strasbourg, and picture every company that lost everything that night, without ever knowing their fate, was tied to a single building they'd never seen. Because in a world that now runs entirely on data, this industry was never really in the business of computers. It was always in the business of certainty, and certainty, it turns out, might be the most expensive thing money can buy.